Well, the real estate market's on fire these days. People are buying and selling homes and making tons of money. So, how do you save on your tax return when it comes time to file? Lisa Green Lewis, TurboTax expert and CPA, is here with us right now. People are making some pretty serious gains out there. I can't say I'm one of them, but they're going to have to do something with this gain come tax time. What do they need to know?
Yeah, so if you sell your principal residence where you live, you're able to get an exclusion of your gain up to $250,000 if you're single, 500,000 married filing jointly. Like you said, Tracy, there have been some huge gains out there, so you want to lower that gain as much as possible. And when you sell, you want to make sure that you include anything that you've done to upgrade your home into your cost basis. Like if you bought a home and you built a pool in your yard, or did a bunch of landscaping or did an add-on in your home, you want to make sure you add that in your cost basis to lower the gain so that you can get that $250,000 exclusion if you're single, or 500,000 married filing jointly.
Right. So those are the sweet spots, right? So if your gain is, God bless, 750,000 and you're married, you want to try really hard to go find the improvements you've made to bring that down, basically increase your original cost of the home. But people should know, right? Just because you put a coat of paint on the walls, that doesn't count. It has to be like the big things, right?
Right. It has to be something that is like a permanent structure on your home. That, like you said, it can't be just like repairs or, painting upgrades. If you use TurboTax will walk you through reporting your sales transactions, and it'll also walk you through what you can include in your cost basis so you maximize your savings.
Right. So siding, windows, roof, all those things, add them up. And then the other thing too, people always ask is, do I have 2 years to roll my gain into the next home? That's long gone, isn't it?
Yes, that's gone. And one thing to also remember, you have to be in your home at least 2 of the 5 years that you own your home in order to get this gain exclusion.
Right. And that's really important too. So if you bought a home and sold it a year later, you're out.
Yes, that would mean that you can't exclude the gain if you weren't in your home 2 of the 5 years.
And just so people know, what is the tax rate that gain? Because it'll have to be put on your tax return. Is it their individual tax rate that it applies to that gain, or is it the capital gains rate?
It will be the capital gains rate, which typically is lower than your individual rate. So, that could be from 0%, 15%, or 20%.
Yeah, so this is really important. So, we're a little over mid-year. Start gathering those documents that or if you are planning on doing work to your home before the end of the year, keep all those receipts so that you have proof when you file your return in April. Lisa Green Lewis, TurboTax expert. Thank you for all of that.
Thank you for having me.